Welcome to the Explainer. Today, we're stepping right onto the trading floor to absolutely dismantle one of the most misunderstood and, frankly, most abused indicators in all of finance, the Relative Strength Index, or RSI. Look, if you've been trading for more than a week, you've seen it. But today, we're taking off the training wheels, tossing out the generic advice, and looking at what actually works in the real world.
Pull up a chair, rookie. Let me ask you a very direct question. Do you honestly think an RSI of 30 means a guaranteed bounce? If you've ever bought a supposedly oversold asset just because some little purple line crossed a magic threshold, only to watch your position plummet straight through the floor and trigger your stop loss, well, pay close attention. This lesson is specifically for you.
Section 1. The Amateur's Trap. Let's dive straight into the painful reality that drains the accounts of everyday novice traders. When an amateur stares at a complex chart setup, they're desperately searching for magic signals. They see a simple line dip and think, aha, a guaranteed risk-free entry. But a veteran, we see the brutal mechanics of momentum and volume trapping the uninformed. We see exactly where retail liquidity, literally your stop losses, is being deliberately harvested by institutional players. The big money needs you to buy so they can sell, and they use basic, widely followed indicators to lure you right into the trap.
Section 2. Under the RSI hood. To stop getting burned and start trading like a pro, we've got to strip away the myth and look at the actual engine.
This tool has been around since 1978. It was designed by a mechanical engineer named J. Wells Wilder. Now think about 1978 for a second. No high-frequency trading algorithms, no instantaneous global data feeds, just human brokers crunching numbers. Its pure mathematical purpose was to quantify the velocity and magnitude of directional price movements, mapping them onto a strict, bounded scale from 0 to 100. It's a momentum oscillator. Basically, it's a speedometer for price action. The real engine driving that calculation? The number 14. By default, the RSI calculates the ratio of average gains to average losses over 14 periods. Now, that could be 14 days on a daily chart, 14 hours, or even 14 minutes. It gives you this smoothed-out reading of market momentum, mathematically weighing the strength of recent upward pushes against the severity of recent downward pulls. If the last 14 candles were mostly green and strong, the number goes up. It is mathematically that simple.
Section 3. The traditional playbook. This is the foundation, but as you're about to see, it's also exactly where the trouble begins for most traders.
Traditionally, the rule seems incredibly simple, almost too easy, right? A reading above 70 signals an overbought asset, meaning it's supposedly too expensive, exhausted, and due for an imminent drop. On the flip side, a reading below 30 signals an oversold asset, theoretically a bargain just ripe for a bounce. It's taught as a perfect pendulum swinging left and right, and it gives new traders a false sense of absolute certainty in an inherently uncertain market. Here's the thing. This classic method actually works brilliantly, but only under very specific conditions. It perfectly balances supply and demand momentum when the market is moving sideways. If a stock is trapped in a ranging market, bouncing between clear established upper and lower boundaries like a tennis ball, those 70 and 30 levels are highly accurate for timing short-term reversals. The market is in equilibrium, so that pendulum logic holds up perfectly. But markets don't just move sideways forever, do they? Section 4. Where amateurs go wrong. This right here is the core of the issue. A rookie sees an RSI hit 70, remembers page 1 of their basic trading manual, and immediately shorts the market. But a veteran knows better. We know that in a strong, trending market, an asset can stay overbought for a very long time as it just climbs higher and higher. To us, 70 doesn't mean sell. 70 means strong bullish momentum is driving the price. Shorting an asset just because the RSI hit 75 is literally like stepping in front of a freight train because you think it's moving too fast. Relying blindly on a standard RSI exposes you to the fatal flaws of basic technical analysis. Think about it. It relies entirely on historical data, which means it inherently lags behind live price action. More dangerously, it completely ignores abrupt shifts in economic fundamentals. An unexpected interest rate hike or a breaking news headline will completely tank a stock, and your RSI indicator won't even know about it until after your account is completely drained. If you're just curve fitting your strategy to old patterns, the live market will eventually break you. So how do we actually survive? We evolve. Section 5. The modern algorithmic edge.
Instead of falling for that basic 70-30 trap, veterans and the algorithms they deploy use dynamically adjusted parameters depending on the current environment. Take the 50-50 crossover strategy. Instead of trying to catch a falling knife by guessing a reversal, they wait. They buy when the RSI crosses above the 50 center line, using that as confirmation to safely ride an emerging long-term trend. Or in short-term momentum environments, they use tightened 60-40 bands to capture rapid breakouts. They adapt the tool to the environment, not the other way around. Today's smart money takes it even further by stacking their indicators. They use a mathematically adjusted RSI to filter out the intense daily noise and fakeouts you see in Forex and crypto markets. They pair it with a MACD indicator to actually confirm the trend direction before putting a single dollar of capital at risk. And, most importantly, they layer in NLP, natural language processing. This means they have software running sentiment analysis on thousands of financial news articles and social media posts, literally reading the market's fear and greed in real time.
This brings us to a really foundational concept. As the latest research proves, there is no magic bullet. They are no longer sufficient as standalone holy grail systems. Their value is realized through optimization and integration. Think of the RSI as just one single gauge on the dashboard of a very fast car. It tells you your RPMs, sure, but you still have to look out the windshield. If you want to be profitable, this tool must be strictly optimized and cross-referenced with trend and real-time sentiment data.
The overarching takeaway from this explainer is a harsh reality. The market has evolved into an apex predator. The algorithms trading against you are processing thousands of variables a second. If your strategies remain stuck in 1978, treating the RSI like an infallible crystal ball, the algorithms are going to eat you alive. You must adapt to the modern algorithm or you will simply become its liquidity. So I leave you with this final thought to ponder before you execute your next trade. Are you trading the actual living market in front of you, or are you blindly following a textbook from 1978? Are you going to keep making those predictable rookie mistakes that institutions prey on, or are you ready to adapt, integrate your tools, and trade like a veteran? The choice is entirely yours. Thanks for joining me on this explainer, and I'll catch you next time.